Okay, welcome back to our second video of our model breakdown series. Today we're going over draw on liquidity and basically going over what types of forms of liquidity that we target to frame our trades.
So in this first example here, we will show how to use previous day highs and lows, session highs and lows, and equal highs and lows to frame out key levels on our charts.
Okay, so in this example we have 930 manipulating lower, which is what we want to see when we have a bullish bias. We have London lows getting swept out, which is our key level, which happens to be a session low. And our draw on liquidity is a session high, which is London high. So not only is it a session high, but there's also equal highs up there, which makes it a liquidity pool. There's lots of liquidity resting there, so given our bullish bias, price is going to want to take that up. So now that we've established our drawn liquidity, what we want to see is a reaction higher after sweeping London low. So we get that reaction, and if you look a little bit closely, we also have a unicorn, which is just a breaker plus an FEG. So we'll just mark that out. So this is one of the entry functions that we use, and we have our targets. Our first targets with our equal highs and London highs, and another target that we also have is previous day highs. So that's also another draw on liquidity that we use. That's really important. So previous day high and previous day low are usually targets that we use based off of whether price is bullish or bearish on the higher time frame. So we see that both of these levels get hit, and that's exactly what we want to see. So now we can go on to our second example.
So in the second example here, we're going to be looking at data highs and lows, and we're going to be looking at FEGs.
So in this example, we're looking at really large candles like these that create ranges for us. These type of candles are made by news, typically CPI and NFP, which release at 8:30 a.m. So essentially what this does is create a range for us to work with. And what we want to see is price create the range and then rebalance the range using PD arrays at the equilibrium point. So let's mark out the half point of this range. So now the price has reached halfway and we see it reaching into a PD array, which happens to be an FEG. Now we want to see if we can find a position to take it back up to the extremes. So watching price play out. We see that that's exactly what happens. And that's pretty much all we use for our draws on liquidity. So keep in mind that this doesn't really even matter unless you're working with higher time frame order flow. You need that in order to form a bias, which is exactly what we're going to be talking about in the next video. So we'll see you then.